Preparing for a structured finance interview? You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each one, you'll see what the interviewer is testing, the core concepts you should cover, and a sample answer. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What is structured finance, and why do issuers use it instead of traditional corporate debt? The interviewer wants to assess your foundational understanding of securitization, asset-backed funding, risk transfer, balance sheet optimization, and why structured products can achieve financing terms unavailable through unsecured borrowing. While answering, focus on pooling assets, issuing tranche securities, isolating collateral cash flows, lowering funding costs, transferring risk, and matching investor appetite to different risk-return profiles. Structured finance is financing built around specific asset cash flows rather than only the issuer's corporate credit. A lender or originator pools assets like mortgages, auto loans, or receivables, transfers them to an SPV, and issues securities backed by those cash flows. Issuers use it to access cheaper funding, free up balance sheet capacity, diversify capital sources, and transfer selected risks. Investors like it because tranching creates different risk and return profiles from the same collateral pool. Question 2. Walk me through a basic securitization transaction from asset origination to investor repayment. The interviewer is testing your understanding of securitization mechanics, transaction parties, asset transfer, SPV issuance, cash collection, servicing, and how investor principal and interest are ultimately paid. Make sure to cover the originator, asset pool, true sale to an SPV, note issuance, servicer role, trustee, waterfall, credit enhancement, and distribution of cash to investors. I would start with an originator creating assets, such as auto loans. Those loans are sold to a bankruptcy-remote SPV, ideally through a true sale. The SPV funds the purchase by issuing notes to investors, usually in multiple tranches. Borrowers keep paying principal and interest. The servicer collects those payments, and cash is distributed through a predefined waterfall. Senior investors are paid first. Subordinate investors absorb losses first, and residual cash may flow back to the equity holder. Question 3. How does tranching create securities with different credit ratings from the same collateral pool? This question evaluates your grasp of credit subordination, cash flow priority, loss allocation, rating agency analysis, and how structural features redistribute risk rather than eliminate it. In your answer, talk about seniority, sequential loss allocation, attachment and detachment points, subordination, expected loss, rating agency stress scenarios, and why junior tranches offer higher yields. Tranching slices one collateral pool into securities with different payment priorities. The senior tranche gets paid first and takes losses only after junior tranches are exhausted, so it can receive a higher rating. The mezzanine tranche sits in the middle, and the equity or first loss piece absorbs initial defaults. The underlying assets have the same total risk, but the structure reallocates that risk. That is why AAA notes can coexist with unrated equity in one deal. Question 4. What is a cash flow waterfall, and what would you look for when reviewing one? The interviewer wants to assess whether you understand priority of payments, deal documentation, cash allocation logic, trigger behavior, and practical implications for investors across the capital structure. Be sure to mention interest and principal priority, fees, senior expenses, reserve accounts, sequential versus pro rata pay, triggers, diversion of cash, and how losses affect each tranche. A waterfall is the contractual order in which deal cash is paid. I would first check expenses, trustee and servicing fees, then senior interest, senior principal, mezzanine interest, subordinate principal, reserve replenishment, and residual payments. The key is not just the normal waterfall, but what changes after triggers are breached. For example, a pro rata structure may switch to sequential pay, trapping cash to protect senior note holders. That shift can materially change expected returns for junior investors. Question 5. Explain the difference between overcollateralization, subordination, excess spread, and reserve accounts. The interviewer is testing your ability to distinguish common credit enhancement tools, explain how each protects investors, and understand how structural protections interact during stress scenarios. While answering, define each enhancement clearly. Explain first loss protection, cash flow support, balance sheet cushion, liquidity reserves, and how these tools reduce expected losses for senior tranches. These are all credit enhancements, but they work differently. Overcollateralization means collateral exceeds note balance, creating a cushion. Subordination means junior tranches absorb losses before senior tranches. Excess spread is the difference between asset yield and deal costs, which can cover losses before principal is hit. A reserve account is cash set aside for shortfalls or losses. In practice, strong deals often combine all four, because each protects investors at a different point in the stress cycle. Question 6. Why is a bankruptcy-remote SPV important in structured finance? This question evaluates your understanding of legal isolation, true sale, issuer insolvency risk, investor protection, and why structured finance ratings depend heavily on entity separateness. Make sure to cover separation from the originator, limited purpose entities, non-consolidation, true sale opinions, independent directors, creditor protection, and uninterrupted cash flow to note holders. The SPV is critical because investors want exposure to the asset pool, not the originator's bankruptcy risk. If the originator fails, the assets should remain isolated and continue paying note holders. That requires a true sale, limited purpose entity restrictions, separateness covenants, and often independent directors to reduce voluntary bankruptcy risk. Without bankruptcy remoteness, rating agencies may cap the deal at the sponsor's credit quality. So legal structure directly affects financing cost and investor confidence. Question 7. How would rising defaults affect senior, mezzanine, and equity tranches in an ABS deal? The interviewer wants to assess your ability to connect collateral performance to tranche-level economics, loss allocation, credit enhancement depletion, trigger activation, and investor return sensitivity. In your answer, discuss loss waterfalls, equity first loss exposure, mezzanine impairment risk, senior protection, depletion of excess spread, overcollateralization tests, and possible cash trapping or acceleration. Defaults first reduce excess spread because deal cash is used to cover losses. If losses exceed excess spread, they start eroding overcollateralization and then hit the first loss equity tranche. Mezzanine tranches become exposed once junior support is depleted. Senior tranches are protected by subordination, reserves, and structural triggers, but severe cumulative losses can still reach them. Rising defaults can also trigger early amortization or switch the deal to sequential pay, which redirects cash away from junior investors. Question 8. What are prepayment risk and extension risk, and how do they affect structured finance investors? The interviewer is testing your understanding of timing risk, duration uncertainty, reinvestment risk, mortgage and consumer asset behavior, and how cash flow timing affects tranche valuation. Be sure to mention voluntary prepayments, refinancing incentives, contraction risk, extension risk, reinvestment at lower yields, slower principal return, weighted average life, and tranche-specific sensitivity. Prepayment risk is the risk that borrowers repay faster than expected, shortening the bond's life. Extension risk is the opposite. Cash comes back slower than expected, extending duration. In a falling rate environment, mortgage borrowers may refinance, forcing investors to reinvest principal at lower yields. In a rising rate or stressed environment, prepayments slow and investors are locked in longer. The impact varies by tranche, because senior bonds may receive principal first, while support tranches can be more exposed to timing volatility. Question 9. How would you model cash flows for a pool of auto loans or mortgages in a securitization? This question evaluates your practical modeling approach, including collateral assumptions, amortization schedules, default timing, recoveries, prepayments, fees, waterfall logic, and scenario sensitivity analysis. While answering, focus on starting collateral tape, scheduled principal, interest, prepayment rates, default curves, loss severity, recoveries, servicing fees, triggers, tranche payments, and output metrics. I would begin with the collateral tape. Balance, coupon, term, seasoning, credit score, geography, and loan type. Then I would project scheduled interest and principal, layer in prepayments, defaults, loss severity, and recovery timing. After that, I would subtract fees and run available cash through the waterfall to each tranche. The model should produce yield, weighted average life, credit enhancement, and loss coverage metrics. I would also run base, downside, and severe stress cases. Question 10. What is the difference between a static pool analysis and a vintage analysis? The interviewer wants to assess your ability to analyze collateral performance over time, compare origination cohorts, identify underwriting changes, and interpret default, delinquency, and prepayment trends. Make sure to cover fixed pools, origination vintages, cumulative loss curves, seasoning, cohort comparison, changes in underwriting quality, macro conditions, and usefulness for forecasting assumptions. Static pool analysis tracks a fixed pool of loans from origination and measures performance over time, such as cumulative defaults or losses. Vintage analysis compares different origination cohorts, like 2021 auto loans versus 2023 auto loans. That comparison helps identify whether losses are rising because loans are seasoning normally, underwriting quality deteriorated, or macro conditions changed. In structured finance, I would use both to calibrate default curves, prepayment speeds, and stress assumptions for future securitizations. Question 11. What are OC and IC tests in a CLO, and what happens if they are breached? The interviewer is testing your understanding of CLO structural protections, collateral quality monitoring, cash diversion mechanics, senior noteholder protection, and consequences for equity distributions. In your answer, define overcollateralization and interest coverage tests. Explain ratio calculations conceptually. Describe cure mechanisms, diversion of cash, and impact on equity and junior tranches. In a CLO, the overcollateralization test compares collateral value to tranche debt, while the interest coverage test compares collateral interest income to required interest payments. If tests fail, cash that would normally go to equity or junior tranches is diverted to pay down senior notes until the ratios cure. This protects senior investors by deleveraging the structure. For equity holders, a breach is painful because distributions can stop even if the portfolio still generates cash. Question 12. How do rating agencies evaluate a structured finance transaction? This question evaluates your understanding of rating methodology, expected loss analysis, stress scenarios, collateral quality, structural protections, legal review, counterparty risk, and surveillance after issuance. Be sure to discuss collateral performance assumptions, default and recovery stresses, cash flow modeling, credit enhancement sizing, legal opinions, servicer quality, counterparty exposure, and ongoing monitoring. Rating agencies look at whether each tranche can withstand losses consistent with its target rating. They analyze collateral quality, historical performance, borrower characteristics, concentration risk, and macro sensitivity. Then they run cash flow stresses with higher defaults, lower recoveries, slower or faster prepayments, and disrupted timing. They also review legal structure, servicer strength, counterparty risk, and credit enhancement. The rating is not just about expected losses. It is about survival under rating level stress scenarios. Question 13. What is excess spread, and why can it be both a credit enhancement and a source of risk? The interviewer wants to assess your nuanced understanding of asset yield, liability cost, fees, loss absorption, spread compression, floating rate mismatch, and reliance on future cash flows. While answering, cover asset income minus note interest and expenses, loss coverage, cash trapping, volatility, declining collateral yield, rising funding costs, prepayments, and stress sensitivity. Excess spread is the remaining income after collateral interest pays no coupons, servicing fees, and other deal expenses. It is valuable because it can absorb defaults before principal losses occur. But it is also uncertain. If collateral yields fall, funding costs rise, prepayments accelerate, or defaults increase, excess spread can disappear quickly. I treat it as a soft form of credit enhancement because it depends on future performance, unlike hard subordination or a funded reserve account. Question 14. If you were reviewing a new ABS issuance, what key risks would you flag before investing? This question evaluates your investor mindset, diligence discipline, ability to synthesize collateral, structure, legal, counterparty, valuation, liquidity, and macro risks into a practical investment view. Make sure to mention collateral quality, underwriting standards, historical performance, concentrations, servicer strength, structural triggers, enhancement levels, legal isolation, counterparty risk, pricing, liquidity, and downside scenarios. I would start with collateral quality, borrower credit, loan to value, seasoning, geography, and underwriting standards. Then I would review historical static pool losses and compare proposed credit enhancement to stress losses. I would also assess servicer quality, backup servicing, legal true sale, counterparty exposures, and waterfall triggers. Finally, I would ask whether spread compensation is adequate for liquidity and tail risk. A good structure can still be unattractive if the collateral trend or pricing is weak. Question 15. How would you explain the 2008 structured finance crisis without saying securitization itself was the problem? The interviewer is testing your ability to discuss market history thoughtfully, distinguish product mechanics from misuse, and identify underwriting, incentives, leverage, ratings, and correlation failures. In your answer, talk about weak mortgage underwriting, misaligned incentives, flawed assumptions, excessive leverage, complex CDOs, rating model limitations, liquidity evaporation, and lessons for modern structures. Securitization was the tool, not the root problem. The crisis came from weak mortgage underwriting, inflated home price assumptions, excessive leverage, poor transparency, and incentives that rewarded origination volume over loan quality. Risk was repackaged into complex structures, including CDOs, where correlation and tail losses were underestimated. When housing fell, losses hit many deals at once, and liquidity vanished. The lesson is that structure cannot fix bad collateral, weak incentives, or unrealistic stress assumptions. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.